All right, so up until this point, I have at least mentioned the idea of Roth plans. Well, today we're going to dive into kind of the mechanics and how they differ from your standard retirement plans. Now, again, just as we were covering your standard IRAs, I made the note that we generally don't think of this as employee benefits. It doesn't mean that employers can't offer Roth style or Roth Advantage accounts. They absolutely can. Okay? We traditionally don't really think of this employee benefits, but we do think about these when it comes to retirement vehicles. Okay, so that's why we're covering this. Okay, now this arrangement, a Roth style account, the savings are not tax deductible. Okay? So if you want to put in 10% of your gross, say you make 50,000, you'll be putting in 5,000 after taxes. Okay, so there's no tax advantage in that sense. You still get the interest accruals, okay, the investment returns, and since you've already paid taxes, the withdrawals are therefore tax-free. So that's the advantage. That's the primary advantage. There's maybe a couple more. And again, here, that quick note, we don't usually think of these employee benefits, but they're definitely important. And we will go through Roth employee plans as well. I'm not saying they're non-existent. Okay, they're just not that common. All right, so when would this be beneficial, either for you or for your client? When would this be beneficial? First, if we want that kind of retirement savings. Now, it's not tax deferred, so it's not pre-tax. Okay, but the withdrawals are tax-free. So that's one reason. This is a long-term strategy. If someone's 50 or 55, I'm not saying it's a bad idea to start, any retirement account at any age, to be frank. But you shouldn't expect to have enough for retirement if you start at 50 or 55, even with the Roth on top of your 401k or a combination of Roth and standard IRA on top of 401k. It's not likely to happen. Okay, not likely to happen. Okay? And then it could be, again, a supplement. But one other advantage, okay, or is the assumption rather, it could be an advantage. The game you're playing, okay, the gamble or the best guess, is really focused on what you think the applicable tax rate is going to be. So if you think tax rates are really low right now, then Roth plans, all other things constant, are going to be more advantageous, right? Because you pay taxes now, but not later when you withdraw. So if taxes are lower now, that's a net benefit to you. So likewise, or on the other hand rather, not likewise, on the other hand, if you think taxes are relatively high now, you might want to wait to pay those. So you might not want to do a Roth plan. Okay? Most individuals, and we're all either finance or risk majors for the most part, most people will diversify. Okay? Put all your eggs into one basket. Now, yes, traditionally speaking or historically speaking, tax rates are very, very low right now. Effective and marginal rates are very low right now. Okay? So if you were advising a client now, you could let them know that. Say, all right, well, maybe if you're used to doing a 50-50 split into a standard, say, IRA or 401k, and then a Roth Advantage account, then maybe put 60% into the Roth until the tax rate may change. Just things to think about, right? So the gamble or the bet that you're making is that taxes are lower now. If they are lower now, then that's a big advantage. If they're the lowest they've ever been, then right now is the best time to do it. All other things constant. Okay, pay taxes when they're low, defer them when they're high. So that's kind of the big kind of takeaway is that the expectations of the tax rate. Okay, again, putting all your eggs in one basket, probably not the safest way to do it. I don't do that and would not advise anybody to. Okay. Other advantage. Okay, so we have those contributions. And we pay taxes initially, but those investment returns, tax-free, eligible withdrawal. We still have, we'll get to the advantages, but you still have the tax penalty if it's prior to 59.5. There are no restrictions regarding an employer's plan, so you still have avenues to say, do this. And you can actually make contributions later than standard retirement plans, so past 70.5. Now, it's not all, great. There are some problems. The first, if you make more than $139,000, you cannot do a Roth IRA. If your individual income is above $139,000, you can't do a Roth IRA. And in fact, the phase out starts around $125,000, and it phases pretty quickly. Now, and this, for households, it's $203,000. But there's something called a backdoor Roth. This is essentially the same with more paperwork. So there you go. The question then arises, well, why is this limitation when there's a workaround? I don't have an answer for that. Okay. It may be that this has changed and we get through the backdoor Roths, or who knows. Okay. Now, there's a $6,000 yearly contribution limit. That includes a standard IRA. So you can't do 6 and 6. It's 6 collectively between the two. So you put 3,000 one, 3,000 the other. So that's for the combination of IRAs. Doesn't matter, well, doesn't always matter with the 401k or your employer plans. Not always. But that's 6,000 for both accounts. Okay? And there's really no magic. If it's a true IRA, it's an individual retirement account, it's nothing to the employer, there's no magic. So the hierarchy tends to be for retirement savings up to that employer match, because if they're giving you the most common, which is 50% up to 6%, then that first 6% of your salary that you put in, you're getting a 50% return on that. I don't know of many other places you can get that, especially not guaranteed. So that's going to be kind of the first step for retirement savings, because where else are you going to get those returns? The next one depends on the applicable tax rate. Okay, and the funds you have. Maybe you can't save more than 6%, but if you can, it depends on what you think the tax rate is going to be. You think they're going to increase? They probably will. You think they're going to increase? Then maybe put a little more into a Roth account than a standard IRA. Okay, so that's kind of hierarchy that you want to be thinking about for yourself, for your clients. Okay. Now, the tax implications, we've already kind of covered this, right? It's all coming after tax. You tell your employer, or well, will be an employer, say I want to put 10% gross. If it's $50,000 after tax, then I'm putting in 5 in it. So you get no kind of immediate tax advantage. We have that limit. I do want to mention, just like with other IRAs, it's either $6,000 or how much you made that year. So if for some reason you made $4,000 that year, you can't put more than $4,000 into an IRA or Roth IRA. It has to be earned income. And here's more information on the phase out. So again, like I mentioned earlier, it starts at $125,000. So if you're making $137,000, you can put $1,200 into a Roth IRA. And these tend to move up each year. It was 136 a couple of years ago. This was 198. So it tends to move up, just like the contribution limits. They're 5,500 this year, and for 2020 it's 6,000. So almost all these move up. Same thing with 401k contributions, as we've discussed. They do tend to move up. Okay, maybe not every year, but they tend to move up. This usually follows around the 90, a little more than the 90th percentile. So if you're at this point in time, if you're in the U.S., you're making $139,000, that's about the 90th percentile. If you're a household of 203, that's about the 90th percentile. It's not completely mated to that, but it follows it fairly closely. Okay, why? Well, because above these incomes, so you're getting closer to the next marginal bracket, so that's less money, that Uncle Sam can get back, right? And we don't want those tax. And another argument is that high of income, then you should be okay, is the argument. All right, some basic plan mechanics then. We're going to talk about distributions, some information on employer-sponsored Roth plans. They would not really be called a Roth IRA, okay, but Roth-style plans. And I do want to compare them not just to IRAs, but to other four series retirement accounts, your 401ks, 403bs, and 457bs. Okay? So the distribution, so you can withdraw from any time, but there's a penalty on the interest that you've earned. Okay? It's still that 10% penalty if it's before 59.5. So penalty on that interest that was earned, because it was tax-free interest. So now you're getting a tax penalty, we could say. Upon passing, it has to be distributed, has to be, we'll say cashed out, has to be distributed within 5 years of death, unless the beneficiary wants to roll it over or keep it into, in their name. So they take the Roth IRA and it's now their name. You wouldn't, like with an IRA, you can roll an IRA into a Roth IRA, but you won't go the other direction. And then that makes sense, right? Because you have this account that's full of money that's already been taxed. It's already after the fact. Why are you going to then roll it into something that upon withdrawal will be taxed again? So it wouldn't make sense, and it's also disallowed. It'd be very, very, very poor decision to do that. But you can't do it. So. Now, quick comparisons here. So what do we not get and what do we get? A little quick pros and cons again, the other comparison being your standard 4 series accounts. You don't get those initial tax deferrals, right? You have that lower contribution limit, just like a regular IRA. And again, that's $6,000 between the two of them. Okay, so not $12,000 total, $6,000 total. So it's significantly less savings a lot. That being said, not many people put $19,500 a year in savings, okay, into retirement. Some do, most don't. There's no matching, but you get more choice in vendors, usually more choice in investment. It's not uncommon to compare the bulk of IRAs to the bulk of 401ks and see higher returns in the IRAs. It's not uncommon. Okay, now with returns, there's some understood risk to that as well, but there's more choice. And then again, we have those tax-free withdrawals. We pay tax initially, and then if we have $1 million sitting in that account at the end of the year, or excuse me, at the end of our retirement, our tenure at our job, it's all ours. Okay. We've already paid tax on it. If we have $1 million sitting in a 401k, it might come out to $600,000. Now, a couple examples: employer-sponsored Roth plans. You can have 401, 403, and 457 sponsored Roth plans. Now, so I'll give you an example here. Ball State, we could opt to do a 403B, our 403B, and or 457B as Roth. We can do both of those. So I could theoretically put, almost $40,000 a year after taxes into retirement. Not many people have that option. I don't do that. But I could. So if you have a Roth option, you have the limitations tied to the 401k or 403b or 457b, not a Roth IRA. So if an employer offers a Roth option, or if like Ball State, you could choose one Roth and one pre-tax, you have a good diversification strategy, and you can save far more than the average person. Again, if you have the savings to do it. Again, not everyone can just forget about $40,000 or even $20,000. Okay. Best plan of action for you guys when you start your first job is to immediately start putting away to the 401k if you think it's a good plan, and just forget about that money so you're not used to it. That's usually the biggest mistake that you might see with your clients, or you might see with your friends, or hopefully not yourself, is that those first couple of paychecks come in because you're used to being, a student. Traditionally, students, you're here for education. You're not always making the money. Some of you are, but not always. But then you get that first job, and it's pretty good. Say it's great, and you get used to that income. That's usually the first thing. So as soon as I start all my jobs, Ball State included, I went ahead and created my budget and forgot about whatever I wanted to save. So that would be my suggestion to you, and to discuss that over with your clients as well. All right. So quick little discussion on Roth plans. Do you guys have any questions before we move to chapter 27? Okay. Now again, the thing that's not on the slide here that I want to reiterate is that $6,000 is for IRA and or Roth IRA. Okay. So you only have $6,000 to play with between the two accounts. Okay. So it's not a 6 in both. Okay. So keep that in mind. Okay. All right.